Our course every Friday night, 7 p.m. with Coach Fetta, certified Grant Cardone coach. Today, we're actually going to be going over a training on life insurance. One of the tools of how the wealthy use their money. And without further ado, I'd like to welcome to the stage here, to the front of the office, Coach Jerry Fetta.
Awesome, thank you, Nano. So we're going to be doing something a little different tonight. So if you're tuning in online, primarily this is a training for my team tonight. And so we're going to live stream this so that you guys can see some of what we do with life insurance. So we're going to go ahead and dive into it. So basically what I want to do tonight, guys, is just go over the wealth creation banking, go over the whole life product, how it's designed, how it works. Now the first thing I'm going to start with here is our pricing structure. So there's basically two different ways when you're working with this you can do pricing. Okay, so when we're working with people on pricing, they're either going to go in at a lump sum. So they're going to either put money into it in a lump sum, and they might do that for at least 2 years. So when they're contributing, they need to be putting in at least 2 years so that the policy doesn't MEC. You guys know what a MEC is?
Explain to us.
So a MEC is the tax limit on a policy. So basically when you contribute to a life insurance policy, the IRS has a limit on how much you can put into it before it becomes taxable. So back in like the 1970s, 80s, wealthy people used to overfund these and avoid taxes. So the IRS stepped in and they put in place what's called the MEC limit, meaning on a 7-pay test, the policy premiums can't outweigh the cash value based on the 7-pay testing strategy. And if that happens, then the policy MECs and it loses its tax-free status. So it now becomes tax deferred, and there's no tax-free loans anymore. So it gets taxed as soon as you withdraw. So when you're working with a policy, the big thing you're trying to avoid is the MEC line. Okay? So the MEC line is the line that if you go past, you're going to get taxed, and the policy loses most of its advantages. I would say all of its advantages in the circumstance we're working in. So they're either going to do a monthly payment, like they're going to stick in like a sacred account, or if people do have lump sums, they can use the lump sums. Okay, and then you're going to want to make a note on the MEC limit. The only time the MEC is a good idea with our clients is when the policy is owned by a 401k. Okay, so if the policy is owned by a 401k, Mike, why would that be okay at that point?
It's owned by a 401k?
Yeah, why would it be okay to MEC if it's owned by a 401?
Oh, because they're going to pay for the taxes.
Yeah, it's already tax deferred.
Yeah.
Okay, so a 401k gives you a tax deferred shelter, therefore you can MEC the policy. And the reason why is basically the withdrawal happens inside of another tax shelter. So think about if you've got one tax shelter and inside of that you've got another tax shelter, you MEC the policy. Well, when you withdraw the money from the policy, it's still inside the 401k and it can't get taxed because the 401k is still protecting it from being taxed.
So that 401k, we want it to be a solo self-directed.
Speak up, Mike.
Is that needs to be a self-directed solo K?
Yeah,
is that what you're talking about?
Yeah, exactly.
Okay.
So it's got to be a self-directed solo K. 401ks can own life insurance. There's just a lot of legislature and ruling around that, so you've got to build it properly. Like there's a seasoning test. You can't have more than 50% of the overall 401k balance going towards premiums. So like when we have clients that are doing a deal, like we have one client now that's putting about $100,000 in their 401k. And so 50 of that's going to go towards life insurance in the 401k. We'll MEC the policy out, and then the other 50 is just going to remain in cash. But that's kind of a bunny trail. That's the only time we really do a MEC. Okay. Other than that, we want to stay away from a MEC entirely. So the pricing structure we do monthly payments, or we do again those lump sums. If they're doing a lump sum, that as long as it's a lump sum over $18,000, that counts towards the $15 per month pricing structure. Okay. So they're doing $1,500 a month. $1,500 a month times 12 months is 18, and so if they do anything on a lump sum over $18,000 a year, they're going to be on that $500 setup fee. Okay, same thing on their $1,000 a month is going to be a $1,000 setup fee. Their $500 per month is going to be a $1,500 setup fee. Okay, now most agencies don't have a setup fee. Can you guys tell me why we have one?
The service, the value add.
Yeah. Mm-hmm. So what are some things we're going to provide that another agency is not?
Well, the wealth creation formula in general, just doing that alone is that's easily a $6,000 product that other financial industries charge for.
Yeah.
We do it for free, basically. I mean, like, yeah.
Yeah, so we're going to do the wealth creation formula. We're going to give them the app. The other thing we're going to include with this is we work with IBC Global, so that's our agency. IBC is going to help us, and we pay them to do this, so we actually lose money for this service. We pay IBC to service the policy for the life of the policy. Whenever our client does a loan or is thinking about doing a loan, IBC will run a full amortization and hypothetical on different options when they withdraw, how they should withdraw, how they should repay it, how much interest they're going to pay, and they're going to get that for the life of their policy. Okay, so IBC is going to run that. We're also going to run any policy changes, like if they want to add more money, if they want to restructure the policy, if they want to do a 1035 exchange, if they want to open a second policy. IBC, we're going to utilize them to run all of those hypotheticals. And again, that's not a free service. That's a service we as a company pay for to be able to give to our clients. And so the setup fee helps cover that as well. So there's a hard cost attached to that. So that's a benefit. We will give them the app. We're going to give them 3 hours of coaching. Okay, so that's going to be one-on-one coaching to build out their wealth creation formula. They're going to get access to our weekly courses. And then in addition to that, we do include our intermediate study volumes. So they're going to get all 9 of our intermediate study volumes, including the courses. That alone, nine books times $60 per course. That's $540 in value just right there. Plus what we pay IBC, that's probably going to cover up the rest of it. So really on the setup fee, we're not making that much money. It just covers our cost to do that. Nano?
So for a person who has no reality on what the wealth creation formula is, can you explain in detail why that would be beneficial for somebody who never heard that term before?
Yeah, so we'll kind of go through this. You do know what it is, though.
Of course.
It's primarily training for you guys.
Yes.
So we'll go through that. Basically, I want to go over just the policy structure first. Okay, so when we structure the policies, guys, we're working with what's called a mutual company. So Nano, what's a mutual company?
Well, definitely one of the companies that we work with, so they pay dividends for us to work with them, as far as being a policyholder.
Right. So a mutual company is going to be a company that treats its policyholders like shareholders, and then they do pay a dividend. You got a question, Mike?
Guardian is considered a mutual company, right?
Yeah, Guardian is mutual, Mass Mutual is mutual. Yeah. And then the companies we work with, there's 4 primary companies that we kind of consider the big 4. Okay. So there's Guardian Life Insurance Company, we work with them. There's Mass Mutual Life Insurance Company, we work with them. There's New York Life Insurance Company, we work with them, we just don't use them. So we have the ability to write through them, we just don't utilize that very much. Certain policies we might. And then there's Northwestern Mutual, we don't work with them. They're in the big 4, but they're kind of at the bottom. They paid a very low dividend rate, and so that's not something we're that interested in. So basically, when we're looking at our companies, we're looking at 160 plus year track record. I think Guardian's right at that 160 line. And then I think Mass Mutual is actually 173 years old. And the neat thing is, if you look at most banks, like look at how long they've been in business. Do you have your phone with you to Google, Mike? Look up how long Alaska USA has been in business.
Well, Alaska ain't been around. We're like the youngest state, so
Yeah.
let's check it out.
So Alaska USA, I'm guessing like probably 30, 40 years tops, if that. Wells Fargo, they're probably the oldest. Wells Fargo has probably been in business maybe 100, 150 years. But the point is, the places that most of our clients are putting money right now are not as stable and as old as the life insurance companies we're working with. Mike?
1948.
1948, okay. So what is that?
61?
61 years.
Yeah.
Okay, so we got basically 110 years over them on Mass Mutual. So that's a big deal, like looking at like companies that aren't around. So Mass Mutual was around when Standard Oil Trust was around. Standard Oil Trust does not exist anymore. Mass Mutual does. Think about that. John Rockefeller's company doesn't exist and Mass Mutual does. Okay, so that's the track record we're looking at when you're working with carriers. That's a big deal. Now, the 6 to 8% dividend is historical averages. Okay, so if you look back in like the 80s, dividends are tied to like the profitability of the company and also their underlying holdings. A lot of those are bonds and they are also our debt. Okay, and when I say debt, lots of times when you hear Grant talking about where he's doing his real estate deals, he's getting loans from insurance companies like Mass Mutual. So like when our clients are doing their policies, quite literally, that kind of money is the kind of money that's being loaned to Grant to go buy these real estate deals. Okay, so that's an important component. So back in like the 80s when interest rates were really high, dividends on policies were legitimately like 10 to 12%.
Wow.
Okay, so 10 to 12%. Right now interest rates are really low, so dividends are like 6 to 8%. If interest rates go up, dividends are probably also going to go up. If interest rates go down, dividends are probably also going to go down.
Wow. So it just matches with the way the rest of the economy is being affected.
Right. Yep. And then it's also based on company profitability. So interest rates right now are like 3-4%, right? We see dividends are 6 to 8, so it's not matching it, but it is going to follow it analogously. Like if it goes up, it'll mirror that. But the reason that's higher is because the company is more profitable than just an interest rate. That's where you're seeing the extra coming in. Okay. Now, most good policies, all the ones we write have a 4% minimum guarantee. 4% minimum guarantee. Okay. So that 4% they're going to pay out no matter what, and anything you see past that is going to be the 6 to 8. So it's 4% plus an additional maybe 2, 3, 4% on top of that if the company basically exceeds their profitability target. Nano?
Why would it be better for somebody to get started on a life insurance versus the 401k that is being matched by the employer at work?
We'll get into that in a little bit.
Got it.
Yeah. So basically the dividend is going to be minimum of 4%. So when you're looking at policy growth, that's going to be what you're looking at. Now because a policy is set up with the MEC line, whatever's inside there is tax-free. So when you put money into a policy, it's going to grow tax-free. Now if you loan against it, it's going to remain tax-free. And the reason why is the IRS can't tax a loan. Okay. Now, if you withdrew it, so let's say somebody, put their money in for 10 years and then they canceled their policy and pulled the cash value out. If they had gains, those gains would be taxable. Okay. So the only thing protecting that money is the life insurance using the loan mechanism. All right. Okay. Now, the other thing I'll hit here today, and I'm going to show you guys a visual on this, is this does give you inflation protection. So when somebody puts money into a life insurance policy, they're not just sticking money in something; they're actually buying shares. Okay, so when you purchase life insurance, you're purchasing it in what's called a unit. And so a unit is $1,000 of coverage. Okay, so insurance is sold at per thousand, which means your cost basis is cost per thousand. And so if you're contractually locking in, let's say $1,500 per month in 2019, then you're contractually locking in the price of that $1,000. Okay, so what that means is 10, 15 years down the road, you're not going to have to worry about inflation because you're contractually locked in on the buying power when you started the policy. You're still getting the same bang for your buck on that cost per thousand, and so your units are actually inflation proof. You're purchasing the same thing you would have 10 years ago or 15 years ago with the same buying power. Very similar to a mortgage. When you buy a real estate deal, you have a mortgage. Your mortgage is basically getting locked in the year you start. 30 years down the road, yeah, it might be a $2,000 a month payment, but we know the reality, Mike, is that that's not actually buying $2,000 anymore, right? Yeah. So that's a really similar aspect. And you guys will kind of notice real estate mirrors life insurance mirrors real estate. They're very similar in the way they operate. And so that's why real estate investors enjoy this so much. There is the leverage aspect, which we'll kind of dive into. The leverage, basically your dividend, let's say it's 6 to 8%. When you borrow against your policy, if it's what's called a non-direct recognition policy, and that's just insurance jargon for when you pull the money out, the company pays the dividend still, then you can leverage the arbitrage. So they're still going to pay the 6 to 8%. You're going to borrow. You might pay 5%, but 6 minus 5 is 1. You're keeping a positive 1% arbitrage. Okay, so that's called a non-direct recognition. Now there is a scenario where basically you have what's called a direct recognition policy. A direct recognition policy means when you borrow it, they're lowering the dividends, and so you're not still earning the dividend simultaneously. Okay, now there's pros and cons to both. So I'm going to give you guys an example. Mass Mutual is non-direct recognition. So when you write a Mass Mutual policy, when you borrow against that policy, Mass Mutual is still going to pay the full dividends. The benefit is if they pay 6 and the interest rate's only 5, you can make a positive 1% spread. Okay. The risk is if the interest rate rides up higher than the dividend, you could lose a 1% spread. Okay. So that's something you want to consider. Now, historically, that's never happened. It could happen because interest rates could do that at some point for some reason, but it's never happened before. So that's something you do want to consider. Now, on the non-direct recognition, what happens, Guardian, for example, is direct recognition. So the Guardian policy, when you borrow against it, Guardian does lower the dividend to meet the interest rate. So Guardian's rate is 4% to borrow, and typically their dividend is going to be around 6%, but when you borrow, they drop the dividend from 6 to 4. So the dividend and the interest rate cancel out. Now, the upside is there's no chance that you can ever end up paying on the interest because it's level now, and it's going to stay that way. Okay. The downside is there's not that natural arbitrage spread. And so, and that's not a huge deal. I'll kind of show you guys on the illustrations. But ultimately, like if you're doing a deal with a policy, so let's say Nano buys a policy and puts 100 grand into it and borrows against it. Nano, you're gonna get cash flow. What are you gonna do with that cash flow?
I'll look for a real estate deal that's producing cash flow.
And then what are you gonna do with the cash flow?
Pay back my policy.
So whether you're direct recognition or non-direct recognition, Nano's paying his loan off early. So you're reducing the principal. So even on a direct recognition where they lower the dividend rate because of the loan, when you pay it off early, you're getting the money back in and the dividend gets credited again. So you're still gonna get the arbitrage either way. The key is though, loan repayment. So you need to repay the loan early with the cash flow. And that's why we call this the sacred account. Like quite literally, this is not for something that's not going to cash flow. This isn't the emergency fund. This isn't like, I can't pay my bills this Friday, I need to withdraw. If you do that, like you're gonna end up just deflating this deal and it's not gonna work, okay? So that's essentially how the loan structure works, and I'll kind of go through the hypothetical illustrations with you guys and stuff. And then the other thing too is this does have a death benefit, right? So the death benefit is a component that does come with every policy. Because it's whole life insurance, the death benefit will grow over time. And that's a benefit. Like if you're just talking insurance, there's term life insurance, which is for somebody that wants really cheap coverage for a short amount of time. There's whole life insurance, which is for somebody that wants insurance forever and they want it to go up in value. Okay, so like term insurance, let's say I did buy a 30-year term policy. I'm gonna have really cheap insurance and it'll get the job done if I die soon. But think about inflation. If I bought $1 million in term and I die 30 years from now when my term expires, my term really gonna do what I need it to?
Nope.
Nope, I'm gonna have less buying power. Probably only gonna have $100,000 or $200,000 in buying power with that term insurance. Okay, so that's something to consider. So when you are looking at death benefit, whole life is nice because you keep it throughout your entire lifetime. Now we never sell it because of a death benefit. We sell it as a savings vehicle, and it happens to have a death benefit. Now with wealth, when somebody is actually building wealth the way we teach them to, estate taxes are going to be a thing. Meaning when they die, if they've got, I think it's just under $6 million,
5.4.
the IRS, 5.4 million, the IRS is gonna take 40% of their estate in taxes. Okay, so if somebody has $10 million, they're gonna lose $4 million off the top when they pass away.
Just because.
Just because the IRS wants that money, so they have the estate tax.
Jeez, don't die.
Don't die. Or you can have the life insurance set up to where when it grows, it meets the 4 million. When you pass away, the death benefit covers the taxes and your family keeps the assets. So that's basically what you can do there. The other thing, so you can pass it to a beneficiary. The other thing you can do too is an individual could sell their policy to an investor. So that's called a life settlement. We actually offer those as investments to our accredited investors. But a life settlement would be, Jerry owns a policy. Jerry would rather have cash. Jerry talks to Mike and Mike says, hey, I'll buy that from you. And so Mike will cash me out usually on a multiplier of my cash value. So he'll look at what the projected earnings and he'll give me some sort of deal where he buys out my policy. I get cash, Mike takes over my premium. When I die, Mike's the beneficiary, he gets the death benefit.
And then there's no estate tax because it came straight to me. There's no.
You're not owed any taxes yet because you're receiving a death benefit tax free.
Yeah.
Yeah. So that's something to consider as well. So there's that aspect. So these are all things you want to look at. Now, the cycle we're breaking is most people are learning, they're working so they can earn an income so they can save and invest. They're getting low rates of return. They're getting lots of risk in the market. They're paying an exorbitant amount of fees. And they're investing with either banks or Wall Street. Or the IRS. Like Nano said with the 401k plan. You're literally a business partner with the IRS for the next 40 years. That's not a good plan. So we're bypassing that by utilizing life insurance. This is something Warren Buffett uses. This is something banks use. And actually, this is kind of a neat statement. The fact on life insurance, banks, their number one asset holding is life insurance. even more than real estate. So banks buy life insurance because they want the growth and they want the security and they want the liquidity. They don't like their balance sheets going down, and they understand that they need to outpace inflation. So when they have assets, so not like Mike deposited money and I loaned it out, like when the bank makes profit, they put their profit oftentimes into, it's called BOLI, bank owned life insurance, and they actually do mech it out. So they'll mech the policy out on purpose because they don't intend on using that money. And then they'll put one of their executives as the insured, so that when the executive passes away, the bank makes even more money than they paid the executive in the first place.
Jeez.
So studying, like when we say study the top 1%, that's not just a phrase, that's quite literally when you watch what people are doing, the wealthy people are using these. Okay, so Lexi, hit the next slide real quick. Before we jump into this, any questions, guys, on anything we've covered, structuring, any of the terms we've gone over?
Mm-mm.
What is arbitrage?
So arbitrage is just a nerd term for the difference between what you're paying and what you're earning.
Okay.
Profit spread, basically.
Got it.
Yeah.
Because I know we use the word arbitrary all the time. I'm like,
It makes you sound cooler if you own a podcast. Now?
No, I looked it up here.
Okay, do you want to read it?
Sure. It says in business, the practice of buying something such as money, gold, etc., in one place and selling it almost immediately in another place where it is worth more.
So profit. Nice. Okay. So any other questions, guys, on structure, policy types, terminology, anything we've covered so far?
Are you still going to explain why a person ought to use this versus a 401k? Are you still going
We
to?
will a little bit here. Primarily, those is a training for our sales team, so I want to make sure you guys have your questions answered.
Got
first.
it.
Is there someone in the comments that's wanting to know that?
No.
No. Okay, so we probably won't hit that then. So other than that, is there any other questions you guys have? Not so much, Nano?
So, let's say if a person dies, right, and they have over like $10 million in their net worth, the government it is going to put their money on 40%.
They're going to keep, about 40% of it for estate taxes.
Okay, so what is it that you're explaining that would be a way to is there a way to bypass that, or the life insurance covers that? How does that work?
So like if you have a policy, so let's get to the next slide real quick. So let's say you bought this policy and you passed away when you were 81 years old.
Sure.
You'd have $19 million in death benefits. So if you passed away and let's say you had, a $10 million estate and the IRS did keep $4 million of that, well, you just got $19 million in death benefit, and that death benefit is going to replenish anything the IRS took.
So basically, there's no way around it.
so they're going to take $4 million regardless.
They're going to take $4 million regardless. The only way around that is to establish a trust and put everything you own in a trust. And then when you pass away, Mike doesn't own anything. The trust owns everything.
But the trust can be
It's
withdrawn
owned
from
by the
because I'm
person.
a family member or a owner, right?
Depending on how it's structured, you can withdraw from it if you make it, liquid and you make it,
Basically,
revocable.
that's like the legacy. The trust
Yeah,
is like the
so a
legacy.
lot of times wealthy people, they make you a trust. They also probably use life insurance, with the trust too. And the neat thing is that you're gonna have this anyways if you're doing this strategy. So it's not like an additional thing you've gotta buy. It's I'm already doing this, and as a byproduct, I'm gonna have all this death benefit when I turn 90 and pass away.
Is there such a way to bypass those state taxes, or the only way to do that will be establishing a trust?
It's gonna be through a trust. Yeah, I mean that's really the only way to do that.
At what point would be necessary to implement one or to have one?
To have a trust.
Yes.
I mean, that's more legal stuff. We don't specialize in that, so that's probably a legal show question.
Got it.
Yeah. So, Lexi, go back to the previous slide. So this is the account 1, account 2 statement. So when you're talking to prospects and you talk to them and they are saving, our primary goal is to help somebody stop saving money in a bank and put it in life insurance instead. Okay, our secondary goal is helping them maybe move 401k money towards that instead, directing it elsewhere. But the main person we're going after, they're probably putting, $400 or $500 a month away in a bank account, $400 or $500 per month away in a 401k account, and they might be maxing out their Roth IRA as well. So account one, and this is from Alaska USA savings rate, earns 0.10%. Okay, we just looked at the life insurance, earns 6 to 8%. So when you're talking to a consumer, like you've got to really look at with your buyers, when you're showing them differences, like comparing apples to apples. What are you earning in the bank? What could you earn in the life insurance? Okay, when you're selling life insurance, one of the things, because there's so many moving parts, one of the things that you've got to keep track of is for the conversation to work through at a gradient, and that way it doesn't get all jumbled up. Because you'd be like, what do you earn in the bank? And they're like, what's that mean? And then you jump into explaining what a MEC is and you never got the answer to your question. So you've got to really track on. So this is a good way for you to keep a linear process to educate someone on how this works. So a bank pays 0.10, life insurance pays 6 to 8. Which one would you pick? 6 to 8.
6 to 8.
100%. Account number one, the bank has a 0% guarantee, meaning you will not lose any money. That's the only guarantee. You're not guaranteed to earn interest. You're just guaranteed that they'll give you back up to $250,000 of what you've deposited, no matter what. The life insurance has a 4% guarantee. Mike, which guarantee would you prefer?
4%.
4%. So that's your minimum dividend.
And it's only up to 200, 250?
FDIC insurance only covers up to $250,000 per account. So if you've got one account with that bank, they'll give you everything you put in up to $250 if they lose all that money. And that's in Creatures from Jekyll Island. It breaks down FDIC insurance. That's basically taxpayer money.
I've seen that where the FBI just goes, FDIC insured.
So can you
banks
explain?
have to be insured to a certain degree.
Yeah, and they're insured by the federal government though, which is funded by Nano.
Yeah.
So if the bank loses your money, Nano's going to pay for it. How do you feel about that, Nano?
Not very good. Okay, so this FDIC protection basically means that if the banks were to default on your money, taxpayers would cover that,
Yeah,
not the bank.
not the bank. If the bank loses their depositors' money, the FDIC insurance covers it, which is federal deposit insurance. And the federal deposit insurance is federal, meaning it's funded by the federal government. And then what's the federal government funded by?
Texas,
So what's FDIC insurance funded by?
our own money.
So if the bank loses money, who's paying for that?
We are.
There you have it. So that's the FDIC insurance. So that's the 0% guarantee. With the bank, there's 100% liquidity as long as the money is still there. So they'll give you everything you put in as long as they actually have it. One of the stories that doesn't get mentioned very much is in 2011 in Europe, when they had that financial crisis, there were banks that were limiting their withdrawals from their depositors to $30 a day. So if Mike had to pay bills, the bank would be like, that's cool, Mike, but you signed a deal with us and we don't have to give you anything you put in, so we're going to limit you to $30. Okay, so that's the guarantee, is it feels like 100% liquidity. Most people that sign up for a bank account, they have no idea what they signed. All the paperwork, they just know they're supposed to open an account, they sign all of it, just like they do with everything, don't read any of it. It literally tells them in there, we're going to lend your money out to other people. That's how bad people are at reading contracts. It literally says in the contract, we're going to lend your money out to other people and we might lose it. Are you okay with that? They sign saying yes. They have no idea. Okay, so life insurance, when structured different ways, it's going to have anywhere from 75 to 95% liquidity. The money is always there, not going anywhere. Okay, so Mike, would you rather have hypothetically 100% liquidity with the chance that you might go there and the money's not there one day, or would you rather have 75 to 95% for sure?
75 to 90. And I've seen it happen where the money wasn't there.
Yeah.
It happened to me a month
Yeah.
ago. They blocked my money.
Yeah.
And I was like, it's there. They're like, nah, really, bro.
They did
Numbers
that
on
to you
paper.
too once, Nano, right?
Yep.
Okay.
Yeah.
So that's a real life example. And share those stories with people, guys. Let them know I've actually gone to the bank and they told me I couldn't have my money. Okay, Lexi and I had that happen. We deposited, we had a deal last year. We made about 40 grand on it. We deposited it, and they're like, oh, that's awesome. Here you go. By the way, you can have this in 3 weeks. And I'm like, I got a business to run. I got payroll and I've got bills. I can't wait 3 weeks for the money I just gave you guys. Like, what are you going to do with it for 3 weeks? And they're like, oh, we just need to, just hold it to make sure it's good. I was like, I held it. It was good. Let's just put it in the account so I can run my business. So that's the reality of banks. Life insurance, or with the account number one, the bank account, it can be accessed by the bank. As you guys experienced, it can be accessed by the federal government for tax liens, the IRS, creditors. Those are all people that can get your money even when it's in the bank, and that's regardless of your permission. Okay, with life insurance, it's what's called a unilateral contract. So a bank account, if you think about, that's a multilateral contract, if you will. It's going to be at least, bilateral, you and the bank. It could be trilateral, you and the federal government. It could be quadrilateral, you and the federal government and the IRS. Or it could be, what would that be, pentalateral? 5?
Yeah.
What's 5? Pentalateral?
Yeah.
Okay, so you, the IRS, the federal government, and creditors. So that's 5 people that can access your money. With the life insurance, it's unilateral. So when you sign up for it, or a client signs up for it, the client is the only one that can access the money and utilize the money. The IRS can't touch it. That's why they made the MEC line. The IRS knows when the money goes in, they can't touch it, so they've got to limit how much goes in. Okay, the insurance company can't even move your funds around. Think about that. The people you did business with, they can't even touch it. Like contractually, you are the only person that can do anything with that policy. Okay, that's control, right? So you're looking for control. Control is income. So there's protected, only you can use it. With banks, they loan your money on a 10-to-1 ratio and pay you nothing. With the life insurance, they actually give you ownership. Instead of loaning your money out to other people, they give you ownership and they pay you a profit. Okay, the only reason this is wrong is the pay you nothing part. Like if Nano deposited money in the bank and they're like, I'm gonna loan your money to 10 people and we're gonna give you 50% of everything we make, Nano would be like, hell yeah.
Here's some more.
Here's some more. Do some more of that deal for me, right? But the fact is that they don't pay you anything. That's why we don't like that system.
And if we lose it, sorry.
Yeah, Nano's the one that pays if they lose it. Okay. So the life insurance company, they actually give you ownership. So again, when you buy insurance with a mutual company, the base death benefit, that's ownership in the company. You actually, you literally own shares in the insurance company. That's where the dividend comes from. Mike?
So if your base death benefit is higher, do you have higher shares? Or like
Yes.
more dividends?
Yeah, so, and I'll show you 2 different illustrations. So when we structure the policies, see how it says 75 to 95% liquidity? So initially, like Nano, when you see 75 to 95%, which side would you rather be on?
95.
95, and why is that?
So I can use the liquidity at a faster pace to put on deals. They're gonna produce cash flow for me.
Okay.
So I can start earning multiple streams of income in different areas.
So Nano is somebody that prefers the higher liquidity, okay? So for me personally, I like the 75%. And the difference would be because Nano has higher liquidity, Nano owns less base death benefit, so Nano's gonna make less money in dividends for the life of the policy. So my policy is gonna grow more than Nano's will because I purchased more shares. Does that make sense?
Because it's a long-term game.
The long-term game,
Yeah.
yeah. And there's not a right answer or wrong answer. So we have some people that are like 95%, I wanna borrow against it tomorrow and go do a real estate deal. And they realize that they're not gonna make the money on the policy, but they will make the money maybe on the real estate deal that they do a little sooner. Okay, so it depends on what they're going for. So 75% on that lower end, ultimately it will outpace, and I'll show you guys on the illustrations, ultimately that will outpace, and you'll end up with more dividends from that, and the policy is gonna grow more, you're gonna have more death benefit later on. And then the 95% is still gonna grow, but usually that policy is gonna have, $1 to $2 million less by the end of the policy than the 75.
Is a client or someone who owns a safe account, are they allowed to vary and change the 75 to 95 at any given time, or is it a new policy, issue, MEC, everything?
So at the time of design,
Okay.
yeah, so once it's set up, it's set up. Usually in the first 90 days, you could renege and change it, but after that, it's kind of whatever you signed up with is what you're gonna have. So it's good like when you're fact finding, that's why we have the illustrations we'll show you guys. It's good when you're fact finding to make sure your client understands the differences on, all right, we can do high liquidity, but do you realize that also means less growth? We can do more growth, but you realize that means a little bit less liquidity. What are you trying to use it for is what that ultimately comes down to. Okay, so somebody that has more money going in up front, like let's say Nano comes to the table with 100 grand, that's actually enough money to do something with. He might want higher liquidity for that so he can borrow against it. Somebody doing $500 a month, they're not going to be able to do anything with the policy for a number of years. So that's where it's like, well, you can't really do much with it anyways other than maybe pay off your credit cards. So lower liquidity with a higher dividend, so you get more growth on the money you're putting into it, might be a better deal for that person.
What is let's say in a 1 year time span, what is the difference on the dividends? You know, you're getting paid on 75% liquidity versus 95%.
So that's a really loaded question. It depends on how the policy's set up. So it's going to be illustration by illustration. So what's their medical? How old are they? So there's not really like a blanket answer for that.
Sure.
But ultimately, like, you know, from what I've seen, like usually a lower liquidity policy is going to have about $1 million more at the end of the policy lifespan than a higher liquidity policy.
But not on a short-term game, like a 1 to 3 year game. They wouldn't play that much of a difference.
So like the high liquidity might break even on year 4. The low liquidity policy might break even on year 7. But then after year 7, it's going to kick ass every single year for the rest of the policy's life.
So you got to be, you know, thinking about like, well, you know, what has the most of my attention right now? Am I looking to invest in a deal within the next 4 to 5 years, or you know, is this something that I'm looking for like the 10-year game?
Yeah, or own 2 policies.
Got it. Okay,
Yeah.
that was going to be my next question. What is the determining factor? How many policies somebody who's healthy and fit, they're 30 years old? How
Just
many?
income, depending on what your income is how many you can own.
Okay, got it.
Usually, Lexi, the companies won't let you put more than like 20% of an entity's income into the policy.
Yeah, I think it's more than no more than 25%.
Okay, so per entity that you're representing, you can put 25% of the income. So Mike could own a policy under Mike Kerrigan that has 25% of his income going into it. His LLC that has its own income could also own its own policy with 25% of its income going into it. His S Corp that has its own income could also own a policy that has 25% on it. So those are all like, there's rules, but there's also, workarounds for all the rules.
Sure.
So that's the loaning on this one. The money doesn't grow in the account while it's there. Neither does it grow when you withdraw it. The bank's not going to keep paying you interest on money you withdrew. Now with the life insurance, there's the leverage aspect. So the money grows in the account and also it grows when you took the money out. Okay, and that's again with a non-direct recognition policy all the time. And then it's even with a direct recognition, it's going to happen still if you're doing lower payment. Okay, so that's something to point out because clients usually don't understand that. Like we had a client today that was like concerned when he withdraws the money, and we reminded him like, dude, when you withdraw the money, you can take it whenever you want it, and it's still gonna grow. So that you're not losing anything. Okay, and then keep in mind on a direct recognition, only the loaned money gets the dividend lowered. So like you're doing continued contributions, your continual contributions will still grow. Okay, so if you're still putting $1,000 a month into it, but you took a $10,000 loan out, you're still going to make dividends on the money you're putting in that didn't get loaned yet. Does that make sense?
Yeah.
Okay. Now, obviously, bank account money is taxable. Life insurance money is tax-free. Bank account money, there's no death benefit. I'll kind of show you with the life insurance, there is one. The banks, this is kind of fun. The banks received government bailouts. The life insurance companies didn't. So who remembers AIG in 2008 when AIG, too big to fail, they went under? Do you guys recall that?
Not AIG, but JP Morgan.
You're thinking Lehman.
Different. Lehman. And also JP Morgan had a bailout that same year.
Yeah, so there's a lot of groups that had bailouts, but AIG was one of the biggest stories that AIG went under. The story that's not told is AIG's banking and securities received bailouts. Their life insurance corporation didn't. The life insurance company remained profitable. The investment company was the one that failed. Okay, so the life insurance companies don't receive government bailouts because they don't need them. Think about how they make their income. It's premium contributions. They have guaranteed income coming in, and then they reinvest that income. So they'll go lend real estate or money to grants real estate deals. They'll do short-term bond deals. For example, Mass Mutual literally bought MetLife like 2 or 3 years ago. MetLife is a giant competitor. Mass Mutual ate them. So one year they're like, yeah, we got enough profit rolled over, we're gonna go buy these guys. So there's another couple $1 billion added to their bottom line. So because of that, they don't need bailouts because they operate their personal finances the way that we teach our clients to. That's the benefit with Mass Mutual and Guardian, by the way. You can literally go on their website and look at their books. They post, here's our assets, here's our liabilities, here's what we brought in income last year, this is what we spent, here's what we've received in loan payments, here's what we paid out in death benefits. You can see all of it. With your bank, you're not going to see any of that stuff. Okay? And then this is kind of just, cherry on top. Mass Mutual, for the last 2 years in a row, they were voted most ethical company in the world. So that's also a big deal too. Like in a financial industry, to have a company in that industry voted most ethical company in the world, like that says a lot. There's a lot of other industries that are more ethical than financial services, and somehow a company in that industry won that title. So that shows you like how clean they run things. With the bank, there are transaction fees for literally everything. Like people whine about the interest rate. What about your ATM fees? What about your overdraft fees? What about your account transfer fees? What about your monthly maintenance fees? That's interest that you're paying to have an account there. There's no transaction fees on life insurance. You want to take a loan, you're not going to pay a transfer fee. Like there's none of that stuff. So no transaction fees. This is big with the bank. It's going to take you 72,000 years to double your money. So that means if Nano puts $1,000 in the bank, in 72,000 years, Nano will have $2,000. Okay, so $72,000 or 72,000 years to double with the life insurance based on the 6 to 8% average. It's only going to take 12 years to double. Okay, so that's not even a fair fight. This obviously promotes the central banking system. This one actively fights against it. There's no central banking involved. Okay, so for somebody that reads or learns about central banking and is like, man, that's evil, it's literally them investing in it when they're putting money in the bank. Like it's like somebody saying, I don't believe in abortion, but then putting their funds in a mutual fund that funds abortion. Like it just doesn't make sense. They don't realize they're doing that with the banking, but you have to point out like, hey, you already know the system's evil. Why would you keep feeding it money? Okay, so that's no central banking, no financial transparency, full financial transparency as we described. So those are just some of these would be advantages in your sales process. So we covered features on the front page. Now we're covering advantages. So any questions on the advantages? Now, anything?
No, I was looking it up, the word bailout, right? Because it says a government bailout. Here it says, become free of an obligation or commitment. Discontinue inactivity. So what exactly does it mean when you say the government bails out the bank?
So the banks had obligations to their depositors, and they were freed from those obligations.
Like a bankruptcy.
They went bankrupt, yeah.
Okay, and no one takes responsibility for it.
Nope, the government bailed them out. Now, the thing you'll watch, if you watch back in 2008, a lot of the financial institutions that got bailout money didn't use that to fix the problem. They used that to pay their executives and buy back their stock. So it's like I go to Mike and say, hey, Mike, Nano loaned me $30. I can't pay Nano back. Can you loan me $50? And then Mike's like, yeah, man. And then I don't pay Nano back. Instead, I pay myself and I buy more things for myself. So that's basically what the banks did in 2008.
And I'm assuming that the government paid them with taxes?
Yep, that's the only revenue that the government gets comes from.
Wow.
So people don't know this though, right? So people don't think about what happened in 2008. They just know like the news said this and I lost some money in my 401k. So this really tells the whole story here. So let's go ahead and hit the next slide, Lexi. So we're gonna jump into some numbers, guys. Can you two see this okay?
It's a little blurry.
A little blurry, okay. Mike, you?
I mean, I know. I just looked at it last night, so I know what you're looking at.
Okay.
The L100
So-
in the middle.
On the far right-hand side, we've got a bank account. So this is showing 3 scenarios. Okay, 35-year-old putting $100,000 away for the next 30 years, every single year. The first one is in the bank account. Okay, the second one is in the L95 with Guardian, and then the third one is in the L100 with Mass Mutual. Okay, so basically what we're looking at is with the bank, this grew to about $3 million. Okay, 3 million. What's the exact number? 3,048,000, Lexi?
What?
What did this grow to?
3,046,953.
Okay, so they put in $3 million of their own money, and over a 30-year period, they made 46 grand in interest. Killer, right? With the life insurance, what did the L95 grow to, Lexi?
6,812,190. Are you still looking at the
The
year
yellow,
30?
Year 30.
Yeah, the 6,812,190.
So this grew to 6 million, and then what did the L100 grow to?
6,073,336.
Okay, so those both more than doubled what the bank did. Okay, now the differences here you can see on the annual outlay. So the only reason someone would do the bank is they're like, well, man, when I put the 100,000, I get the whole 100,000. But you gotta ask them, would you rather have 100,000 or would you rather have 6 million? So anyone that tells you I'd rather have 100,000 is not your client. They're short-term thinking, and they don't have 100,000. Anyone that tells you 100,000 and they have more than 100,000, like they're not gonna say that. They're gonna be like, well, I need this to grow, so I care more about the 6 million. Okay, so they're not thinking about like, because it's not their last money, or it's not money they don't have. Okay, somebody that's broke that doesn't have 100,000, their fantasy is to keep 100,000.
Yeah.
They just want to hold it and touch it. It's like a kid that's never dated before. They spend every minute they have with the girl. Or you've got somebody that's married and they're like, yeah, I don't like. I'll see her when I get home, but I gotta go do stuff. Okay, so that's the difference, right? So you've got in the middle the L95. So on this one, it's gonna have. Now this is kind of cheating. The L95 we put on an index rider. So the L95 index rider, it gives you like the index combined on Guardian, the index of the company dividend, plus some participation from the stock market. Okay, now it still can't lose money, so none of this is invested in the stock market. They just watch what the market did, and if the market outperforms, then they credit you some of that instead of just the company dividend. Okay, so this is a little bit of a cheat because typically Guardian doesn't outperform Mass, other than when we put that rider on. And usually we will, unless the client is totally against it. Usually we'll put that rider to get some extra growth. Okay, so with this you see it 71,000 going in. Okay, so you got less liquidity, but you got more growth, right? So that's again less liquidity but more growth. So that's an example of this guy understands I'm gonna have less money in year one, but I'm gonna have $6.8 million when I'm ready to actually utilize this in 30 years if that's what they're thinking. Okay, scenario number 2, you're gonna have higher liquidity, but you're gonna have less growth. Higher liquidity with less growth. So this guy has 75,000 available, but his only grows to 6 million and some change. He's $800,000 less in actual growth on the policy. Okay, so you guys were asking a little bit on like how do you tell the differences. This guy owns more base death benefit. This guy owns less base death benefit. Okay, so because of that, his is gonna grow more because he's getting more credited dividend. So like the dividend is still 6%, but it's 6% of a bigger number. So you're getting more firepower. This one, it's still 6% as well, but it's 6% of a little bit smaller number, and over time that's gonna compound differently, right? Now the big difference is maybe on the loans. So if somebody borrowed against the Guardian, that might slow down the performance a little bit if they're not repaying their loans because it's direct recognition. That dividend comes down to meet the interest till they pay it back. So that might slow it down a little bit. Mass Mutual, if you borrow against it, you're still gonna get the full dividend credit. And that's where you wouldn't see any numbers change here because it's still the same representation because it's full dividend. On this one, you might see the numbers change slightly on a loan if you're not repaying with the cash flow. Okay, so when you're putting these together, like you wanna really do a lot of fact finding and you're showing the benefit at this point. Okay, so you're not hitting features, you're not hitting advantages here, you're showing benefits. Features was what we covered on the first page. 160 years old, 6 to 8% dividend, 4% guarantee, those are all what it does. That's a feature. The advantage, you're in the bank, this is what you're getting, this is why the life insurance is better. Okay, the benefit is, you want 3 million, you want 6.8 million, or do you want 6 million? Well, I want 6.8 million, okay? Well, let me ask you, do you want 6.8 million, but you're gonna have a little bit less money initially? Or do you want 6 million and you're gonna have a little bit more money initially? Or do you just want the bank? You have all your money initially and nothing in 30 years. You get 48 grand. Okay, this is not inflation adjusted, by the way, so this guy actually lost money.
Oh, shoot.
Okay, so this is stuff you're looking at. Any questions just off the cuff on like what I'm covering on the cash values?
Not on the cash value, but I'm just curious on the L95I.
Yeah.
Because on the first 7 years, the obviously you have the rider on there, so the death benefit is really strong.
Yeah.
So why is it like that, and like why does it drop off like pretty much 50% of death benefit after the 7th year?
That's an excellent question, Lexi. So what did we say on the MEC? How many years is the pay test?
7 years.
7.
7-year pay test. So what do? We put an artificial term insurance rider on there for 7 years. Show the IRS what they need to see, and as soon as we're past the 7 years, we cancel it.
Huh.
Okay, so your death benefit drops down to 4.3 million, which means that initially you probably only had like $3 million in death benefit, and the policy would have met. The IRS didn't say how the death benefit needs to be on there, so we just purchased a $30 a month term policy and stuck it on there to show the IRS what they need to see.
Okay, say that again.
So see how it says 8 million for the first 7 years, and then after that it drops?
Okay.
That's because if the death benefit was lower, the policy would MEC. Okay, so the natural base insurance on the policy would MEC at that level, so we put a term insurance rider on there for 7 years to artificially inflate the death benefit, so that when the IRS runs the 7-pay test, they're like, oh yeah, this policy is good. Then as soon as we're past the 7-year window, we cancel the term insurance rider.
Okay. So you could just put more money into your policy and put a term insurance inside of it if you need to.
Yeah, and that's when you talk to like insurance agents that are all about the MEC policy, just put more term on there. Like you just increase the death benefit and the MEC policy goes further down the road. It's like the debt ceiling. Yes, it exists, but you just kick it down further and then do what you want to do. So with that standpoint, the only actual limitation on a policy in general is income, which is the only actual limitation on saving money
General.
at all. Okay?
So if somebody was only putting in like 12 grand, a year, just an example, and they only had like what the policy says with the say 2 million in death benefit. So if that person wanted to increase their death benefit, they could just basically add more term insurance, right?
Mm-hmm.
If they wanted like a $50 million death benefit, they would just purchase that with the term insurance.
Yeah.
And still keep the same annual premium that they're paying towards the actual like whole life policy.
Right. And that's where on the setup fee. So let's say Lexi's scenario played out there like, man, I'm signing up $12,000 a year. We design the policy and set it up. Let's say 5 years into it, they're like, dude, all this wealth dynamic stuff has been working, and I can now do $50,000 a year, not $12,000. So IBC Global is actually going to help us take the current policy, restructure all of it, run the hypotheticals so that we know it's going to get them that MEC limit at $50K, and then reissue the policy at that. And we charge them nothing extra. So we really wrap your mind around the setup fee. I had a client the other day that was giving Nano trouble over the setup fee, and I talked to the client. I was like, dude, this is literally like what you're getting for the rest of the life on the policy. We're actually losing money on this. Okay, he was worried about the $1,500. I was like, you're gonna have this for 60 years. That's $22 a year, and you're getting all of that service. Like we should be charging a $5,000 setup fee. $1,500 is cheap. Okay, so that's what's included in there. So that's where you see here. The MEC limit on this one is a little different. So you guys can see, Lexi, do you want to read the death benefit on the L100, like the first couple years?
Yeah, on the first year is 7,175,572.
Okay, and does this one drop or no?
No, it goes up by like a couple 100,000.
It never drops?
Nope.
Okay, so this is an example of one because of the way it's structured with the higher liquidity. It had higher liquidity, so it's not going to grow quite as fast. And then basically because of that, it's going to have the base death benefit set from the beginning to grow, projected to always outpace the MEC. So it doesn't necessarily need that giant lump sum of term insurance. The base death benefit naturally grows. And so this one is set up to where that paces the MEC line, and it kind of always stays ahead of the game. Okay, so those are two differences in policy structure. If something is structured a certain way, you might need to have a higher term insurance rider, and that's where you see big drops like that on an illustration. Or it's structured to where the base death benefit is naturally in sync with the growth of the policy in that mech line, and you don't necessarily need that giant drop off. It just always kind of keeps pace. Does that make sense?
Mm-hmm.
Cool. So that's kind of policy design. Let me think if there's anything else I want to hit with you guys on this. Do you guys have any questions on anything we've covered so far?
So the one in the, the two on the left is the difference between 75% liquidity and 95.
No. This is actually showing 70% and 75%. So this is not 75, 95.
Okay.
For the 95, that would be a different illustration we'd look at. And the only one that's going to do that is Guardian, and that's called executive strategies. So that's got to be done through a corporation. And that's only if someone's putting more than $100,000 per year into it. At that point, Guardian would allow them to have that much liquidity. So money buys more liquidity if you've got more to put in.
Yeah. So everybody's gonna got mass for most of our clients.
Not necessarily. So they can still do Guardian, right? So they can still do Guardian if they want more growth on that.
Okay.
Mass, they're not going to have as much growth, but they're going to have a little bit more money up front in most cases.
Okay. Makes sense.
So any questions here? Cool. So let's jump into loans real quick. So the loans, the way you take a loan, you can do it through your app. So if a client wants to take a loan, they can literally just go onto their app and request a loan. If they request it through the app, the life insurance company is going to mail them a check, and then they'll receive the check in the mail and go deposit it. If they do it through us, we can fill out ACH paperwork, and then the life insurance company will direct deposit it. The reason it's like that is somebody has to test for money laundering. Okay, so when you do the loan on the app, the life insurance company doesn't just send you the money, they've got to slow it down and create a paper trail. So if anything comes up, they're like, yeah, we got the request, we looked at it, we checked the policy, everything was good, then we sent Mike the check. If they do the ACH paperwork, we're the ones filling that paperwork out, then sending it into the insurance company to ACH. So they can always say we documented.
It's for so they can have paper trail.
Just to have a paper trail. If anything ever came up, they don't want a scenario where they're like, yeah, Mike requested the money, it got sent out to him, and like we didn't check it, we didn't look at it, we never made sure it wasn't money laundering, we never made sure it wasn't terrorism. So they have a lot of those locks and stuff on there because it's unilateral. So once the money's in the policy, like they can't touch it, the IRS can't seize it, none of that stuff. So the best control point the insurance company has to cover their own liability is when it leaves, they just need to make sure that they're aware of that, they document it and then send it to you, and they do that through a paper trail. And that's either going to happen by them, doing it on their own and then mailing that to you, or us doing it in office and then them ACHing it to you. Okay. So the loans you can take at any time. Like if you put $1,000 in, or in this case you put $100,000 in, you'd instantly have about 75 grand in that match policy, and you could borrow all of that 75 grand out immediately.
What's
Okay.
the time frame for some? Let's say if I have $10,000 there, and I do the request via the app, what's the time frame for me to receive the money?
Usually within the week, right?
Yeah, 7 to 10 business days.
Pretty quick.
Yeah.
Very
So you
quick.
want to know about it. Obviously, this is going to be for investment deals.
Sure.
So the principle of investing, a quick deal is never a good idea. So if you ever need money in 24 hours from a deal that you just found out about, we don't want you to do that anyways. So you want to know ahead of time and then request the check, make sure it's all good, etc. That's part of the due diligence process on a good deal. So that's going to typically be like 1 to 2 business weeks basically, depending on when you requested it. When you borrow against the policy, the loan is interest only. So it's not principal and interest, it's interest only. And then it's basically a once a year payment. So your loan interest is due on your policy anniversary date. So if you issued the policy in February of 2019 and then you borrowed against it that same month, you wouldn't have to pay any interest till February of 2020. Okay, so that's something to consider. Is it's not a monthly thing you've got to do. If you pay your principal down or off, that also reduces the amount of interest due, right? So like if I'm cash flowing on a deal and I'm paying my loan, my cash flow back on my loan, that's going to reduce the amount of outstanding principal, and they count the interest daily. Okay, so if I paid it off that day, they're gonna go all the way down to the day I paid it and stop the actual interest due because I paid the loan off, and I've only gotta pay it for the days that there were an outstanding balance. Does that make sense? Okay, so you can really get really fine-tuned with that. The dividend is also credited once a year. So your dividend payment also gets paid out to you on your policy anniversary date. So this is one you want to make sure clients are aware of, is the dividend usually gets announced like November. But if your policy anniversary date wasn't until March, you might have got announced in November, but you don't actually see yours till March. So you want to make sure clients know that, so they're not like, hey, I saw it got announced, but I didn't get any money. You will get it, it's just on the anniversary date. And you can do one of two things on your dividend options. You can have your dividend options, put into paid up additions, or you can also have them pay off the loan interest rate for you. So it's kind of like when we do the solo 401ks, the client can either pay it with their 401k balance and then reimburse themselves later, or they can just pay it on a credit card. Same thing with the life insurance. With your loan interest, you can either have the policy dividend cover the loan interest, or you can just pay the loan interest with your cash flow. Like mathematically, it's still going to be I earned 6 and paid 5, but you can literally pay the 5 out of your cash flow, or you can have the 5 paid by your policy. So those are the two different options. On Guardian, that's less applicable because the interest rate and the dividend cancel out. So it's just a net zero. You don't have to pay any interest, it's just a zero. With Mass, you do pay the interest, but you also earned that 1% spread. You just have to figure out how am I going to pay that interest payment, whether it's from my dividend or from my cash. Make sense? So any questions on loans?
Just on the time frame that, if you do through the app, about 2 weeks or 7 to 10 business days. If somebody comes through us, what's the time frame for them to receive their money?
That's more like, how long?
3 to 4 business days. It still has to go through kind of like an underwriting process where they still have to check, make sure it's not like terrorism or something.
So one basically takes, about a week, the other one 2 weeks.
Yeah.
Yeah, something like that.
Yeah.
Okay, good.
Yeah.
Any other questions?
Nope.
Cool. So the big things you want to take away on this is, again, when you're explaining this to clients, you want to know the differences on the features. Okay, the features are going to be applicable to pretty much every policy. The advantages are going to be applicable to pretty much every policy. The benefits are going to be different based on the policy structure. Okay, so you want to know, with the benefit, what's in it for me? What's in it for you is different based on what you set up and what you're going to use it for. Okay, so a client that's paying off debt, what's in it for them is different than a client that's going to take $100,000 and put it into real estate right away. So you don't pitch that policy the same, and you don't show them obviously the same end result. It's like, all right, well, you're going to use this for real estate, so this really is not your wealth builder. This is going to give you 1 to 2 points of interest on top of any real estate deal you do, and have uninterrupted compounding with the death benefit that grows as well. So it's like you're going to go make money in real estate. That's the vehicle, 12% or whatever you're earning. If you do the money here instead of the bank, I can give you an extra 1 to 2% no matter what. Arbitrage. Okay, a client that's paying off debt, that's a different story. You're going to pay off debt. You can either do it that way and have nothing left over at the end, or you can do it this way, and it might take you slightly longer because you're saving as well. But when you're done, you're going to have all of this money that's been uninterrupted on the compounding and be debt-free. And you'll have, this growing balance that you can utilize right after that. So you're not going to go back into debt ever. Okay, so the big point is don't save in the bank. Now, this is not talking we're not talking IRAs, 401ks tonight. It really is. If a client's putting money in the bank, this is why it's better. And the other thing you're going to run into, and I'll give you guys just a real quick on this, is inter-industry competition. So when you start talking to people about life insurance, you're gonna have a couple different groups. You're gonna have the financial advisors. Realize they're selling managed assets, so they're gonna always be like, well, the stock market outperforms, blah 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 blah. Well, we're not selling the stock market. If we were comparing that, then we would be showing them real estate. So the argument is not life insurance outperforms the stock market. Real estate does that. Our clients are going to do real estate, which is better than the stock market. The life insurance is what they're going to put the money until they do the real estate. So never get caught up in arguing why life insurance does better than the stock market or doesn't. It's not the same purpose.
Yeah. This is just
Okay.
a tax sheltering tool.
Yeah. Okay, so when you hear someone that's like, well, the market did 8%, then be like, yeah, Grant's real estate portfolio did 15. Standard asset pays 8.5. We have got clients that earn 12 right now. That's where it's apples to apples. We're just saying this is better than a bank.
Yeah.
Okay, because you got to put the money somewhere till you do that real estate deal. Okay, and then the other group you're going to run into is other insurance agents that don't understand this. And they're going to feel like they do because their company put them through lots and lots of classes to embed them in the culture, which is a good thing. We do that with our people too, but they're going to just repeat what their sales manager told them. And so they're not going to know about like the banking philosophy or any of that stuff. They're just going to be like, well, permanent insurance is for those that want, permanent insurance forever, and it's going to cost a little bit more and it's level. Term insurance is like renting. And that's the bulk of their argument. They're probably going to primarily sell indexed products or variable products because those on a piece of paper show that they grow faster and they pay a higher commission.
Those are the IULs, right?
The IULs, the VULs. Okay, hypothetically that pays more growth because it's credit to the stock market. But on IUL, the product itself has only existed for, let's say, 8 years. But the market has existed for hundreds of years. So they'll reach back and do a hypothetical and be like, well, over the last 20 years, this policy would have done this. And it's like, no, the market index did. Your policy's only been around for 7 years. So you can't, on the illustrations, when you're doing competitive stuff like that, realize when they show an illustration, it's bullshit. Like you can't base it off of like, the market did this over 27 years and our policy is indexing that market, but our policy's only been around for 5. That's not the same thing. So realize that. The other thing too is on index products. See how our death benefit goes up? The cost doesn't. Your cost stays level. On an index product, the cost of insurance goes up every year. Yeah. And the way that they offset the cost is pulling it from the cash value. So the insurance policy literally is cancerous. It eats itself over time. And then eventually what it does is these premiums get so high that it liquidates the cash value and the policy lapses, which means it cancels. The policy's broke. It goes bankrupt.
What kind of policy is that?
Index universal life. Okay, or the way they prevent that is they put a rider that guarantees that that'll never happen, and there's a giant fee that the client's going to pay to own that rider, and it basically levels it out to where it grows about the same as a whole life policy would in the first place. So like you want to know this stuff too. Same with variable universal life. That's going to actually literally own mutual funds. So it's a universal life policy. The premium goes up every year, and also it owns mutual funds. And so you're paying mortality costs, you're paying M&E expenses, you're paying asset management fees, you're paying commissions. So like on a VUL, oftentimes when you look, the client's paying 4 to 5% in annual fees. Just on the M&E costs and their management for the underlying portfolios. And that one is even worse because it can lose money. Okay, so the market could tank and the entire cash value gets cut in half and the premiums keep going up.
Yeah.
And the policy lapses because the market took it down and the premiums went up. Or you can pay for a rider, which is the same thing. You're gonna pay a butt ton of money for a rider to pretend that, or to guarantee that that'll never happen. Ultimately though, like numbers are numbers. If a company loses enough money, it's not gonna guarantee a rider. The rider is based on the company's solvency. So I know that's a lot of data, guys. I wanted to dive through this. Any questions you guys have?
Who the hell would sign up for a policy like that?
Somebody that doesn't know. I mean, that's really it. Is the agent pitches it and they show the growth. So like with a IUL and a VUL, they're only selling on this line. If you put in this, it's going to turn into this. It averages 10%. The market did this, and that's all made up because it was in the past and it doesn't apply to the policy. But the buyer doesn't know that. So they're like, oh yeah, that looks like way more. So they'll sign up for the more because that's going to be a bigger number when they get to age 60.
That's on the IUL policy.
Yeah, IULs, VULs, yeah.
Yeah, I was speaking with a client last night where they have a New York Life policy and they're like, well, it's great for the next 5 years, but the premium's going to double. You know, and and like they're like, what's next, basically, you know?
Yeah.
Because they know they're, at the current state with what they have to figure out a way to make more money or borrow against a 401k, you know, like. doesn't
Yeah.
make any sense.
Are they able to use the money just like in the whole life policy where they can borrow against on the IUL, or that's like rent money?
Usually on an IUL, they can't touch the loan for about the first 10 years. And there's surrender charges if they do, so they're going to pay giant fees if they do that.
Mm-hmm.
And then they will be able to borrow against it, but when they borrow against it, it doesn't keep growing.
Yeah, it pauses.
So the growth stops, and then they just borrow the money, and then they pay it back later. So any other questions, guys, on policy structure, design, numbers, any of the stuff we've covered tonight?
It's pretty clear. Probably watched this video like 10 times.
Awesome. So we'll go ahead and wrap it up. If you guys are watching online, this was a private training we did for our team tonight. We streamed it because this is the nuts and bolts of whole life insurance. There's a lot of myths about it. It's a service we highly recommend. If you're watching this and you're interested, reach out to us. We'd love to show you the same numbers and go over this more in detail. If you're watching this and you're just infuriated and you're confused and you're upset that we're telling you to put money in life insurance, you need to reach out to us too, because there's something you don't understand about the product, and there's something you don't understand about what you personally own right now. So we're going to go ahead and sign off. Thank you guys. We'll talk to you next week.